Everyone keeps saying the move is finished. They're wrong. And the scary part is this. The biggest mistakes in silver don't happen when price is boring. They happen right after a headline number hits. Everyone feels smart and the crowd starts congratulating itself like the game is already won. That's when people hand their position to someone else, right before the next wave rips their face off. As I'm recording this, it's Friday, January 23rd, 2026, and the exact time is 10 a.m. Drop a comment with what time you're watching, because I want to see how global this audience really is. Also, quick note, the stats show a huge chunk of people watching these videos haven't subscribed yet. If you get value from this kind of real-world market talk, help me out. Hit subscribe so you don't miss the next update. Now, today we're going to do three things, fast and clean. First, I'm going to break down what this latest surge in silver is actually telling us and why the profit-taking you're seeing does not automatically mean the party's over. Second, we'll look at the gold-silver relationship and what it's quietly signaling underneath the noise. And third, we'll talk about the forgotten metal that tends to wake up late then sprint like it's trying to catch a train, because if it starts moving, it changes how you think about the whole precious metals complex. And yes, there are bonus links in the description. There's a premium WhatsApp channel link for daily updates, and there's a channel membership join link if you want deeper dives and extra content. All right, let's get right into it. In the last stretch, silver didn't just rise, it exploded, ran straight into that psychologically loud area near the high double digits, and then started doing what markets always do after a sprint, breathing. Some people are celebrating, some people are panicking. And in the middle, you've got a strange thing happening in the retail world. Buyers and sellers showing up at the same time, both convinced they're the smart money. If you're seeing people dump metal back to dealers, understand something. Not every seller is calling the top. In real life, people sell because rent went up, groceries went up, a car broke down, debt payments squeezed them, or life just happened. This is the part of the story that never shows up on a chart, but it's real. And it's also the reason you can see heavy selling pressure at the exact same moment that the structural bull case remains intact. Here's the trap. The human brain loves clean narratives. Price went up a lot, therefore it must crash. That's not analysis. That's a bedtime story your emotions tell you so you can feel in control. Before we go deeper, I need you to notice the game the market plays right after a big run. It starts producing reasons for you to leave. A scary chart, a dramatic headline, a confident voice saying, "It's the same movie again." Sometimes it's manipulation. Sometimes it's just lazy pattern matching. Either way, the outcome is the same. People hand away strong positions because they want emotional relief. Here's the lesson that keeps you alive in silver. Stop thinking in one outcome. Think in routes. One route is the grind up. Higher highs, ugly dips, then higher again. Another route is the stall. Price goes quiet for weeks or months, and boredom shakes out the crowd. And the third route is the punch in the mouth. Something breaks in the broader system. Forced selling hits everything, and silver drops, even if the long-term setup is still intact. If you're only prepared for the grind up, the punch in the mouth will make you capitulate at the worst possible moment. So, build your plan for the ugly route, not the easy one. Now, I also want to talk directly to the people who don't own any metal yet. I see you. You're waiting for the perfect dip. That's normal. But it's also how people miss phases because markets don't hand you perfect entries on schedule. They give you uncomfortable entries. So for most people, the best approach is boring and powerful. Stagger your buying. Break it into pieces. Decide the rules before the emotions show up. And never lock up money you may need quickly because the market loves forcing sales at the worst times. Let's get practical for a second. There are two silver worlds sitting on top of each other. The paper world is fast, liquid, and violent. Futures and options can swing price like a wrecking ball. The physical world is slower, but it's the part that actually feeds factories and fills vaults. When pressure builds there, it leaks into reality through premiums, delays, and awkward availability. So don't just stare at spot. Watch the real-world friction. If price pauses, but physical stays tight, that's not nothing. That's a spring compressing. And yes, you'll see dealers spotlighting certain items week to week. Popular bullion coins, fractional gold, older silver coinage priced by the ounce. Sometimes those deals are inventory cleanup. Sometimes it's marketing. Sometimes it's both. Use it as a reminder. Be intentional. Buy with a reason. Sell with a reason. Don't let hype be the reason. Now, let's widen the lens on the gold-silver ratio, because this is where the next surprise often hides. In older monetary systems, governments tried to lock the ratio to fixed levels, often around the mid-teens. In modern markets, it can stretch to extreme levels in fear moments because gold is treated like shelter and silver gets treated like industry. So when that ratio compresses from very high levels, it's not just silver up. It's a shift in psychology from protection to reflation. But here's the twist. After a sharp ratio drop, it often pauses. During that pause, gold can look like it's winning again for a bit, and people misread it as a silver failure. That misread is exactly what resets positioning for the next silver burst. Now, about those giant target numbers people throw around. Could silver print crazy nominal prices in a world where the currency unit is being watered down? Sure, nominal numbers can go wild when the measuring stick is shrinking. But chasing a number is not a plan. A number won't tell you when the market is overheating, when social media is turning it into a cult, or when leverage is becoming a landmine. So watch behavior instead. Are daily ranges expanding fast? Are we seeing relentless vertical candles? Are people borrowing to buy metal because it can't lose? Those are the danger signs. Now let me answer two questions I keep getting. First, did I miss it? You didn't miss a price. You missed an early chapter. Chapters repeat. If you want in, use discipline, not desperation. Second, should I switch to gold because it feels safer? Gold is usually less violent, that's why it often leads first. Silver is usually higher torque, that's why it often outruns later. Your mix should match your stomach. If volatility makes you panic, lean gold. If you can tolerate drawdowns for more upside potential, keep silver in the picture. Many people do both and rebalance when the ratio gets extreme. Now, a bigger question that hardly anyone asks, but should. What if policy changes get messy? In stressful eras, governments can change rules, tax treatment, reporting, movement of capital, even access. I'm not saying that happens tomorrow. I'm saying your plan should not depend on everything staying polite. That's why I keep emphasizing community and education, not just charts. And on that note, if you've had any real wins, medals, or otherwise, share your success story in the comments, not to show off, to keep someone else motivated who's grinding through their own learning curve. Now, a final note on platinum since we brought it up. The opportunity is that it's scarce and sometimes gets re-rated late in cycles. The risk is that it's tied to industrial demand and can lag if manufacturing slows. So, treat it as a satellite, not your whole identity. All right, here's the cliffhanger to carry into the rest of this video. The next move that shocks people won't arrive when everyone is excited. It'll arrive when the comment section gets quiet and the crowd gets bored. One more thing before we jump back in. Keep an eye on real yields and liquidity. When real yields slide, metals tend to breathe easier. When liquidity dries up, even strong assets get sold to raise cash. That's why you can see a nasty downdraft that looks illogical on fundamentals and then a sharp rebound when funding stress fades. If we get that kind of shakeout again, the key question won't be why did it drop? It'll be who was forced to sell, because forced selling creates bargains for prepared buyers, and it rewards patience more than prediction. The better way to think about it is to separate two forces. Force one is the trading crowd. They chase momentum, they use leverage, and they treat silver like a casino chip. They can push price around in the short term, especially during thin liquidity moments. Force two is the real economy. Manufacturers, refiners, fabricators, mints, wholesalers, and the people who need actual ounces, not a chart. These are the forces that matter when a market is tight. When those two forces line up, you get a violent move. When they fight, you get chop, whiplash, and the kind of candle that makes people quit at the worst possible time. Now, I want you to pay attention to something that sounds boring, but is actually critical. How much of the move is still ahead of you when a market starts to curve upward? There's an old idea in trading that most of the profit in a big trend doesn't come evenly. It comes late. It comes in a compressed window. The last slice of the move tends to deliver an unfair percentage of the total gains. That's why so many people do everything right for months, then sell right before the final acceleration. But let's be honest, that concept can become a drug. People hear the final leg is coming and they turn off their brain. They stop managing risk. They start fantasizing. And fantasy is how bull markets steal your money. So I'm going to give you a framework that keeps you sane. 1. Accept that nothing rises in a straight line. Not silver, not gold, not anything. Markets move like a staircase in an earthquake. Up, then shake, then up again. 2. When you see a big surge and then a stall, don't ask, is it over? Ask, is the market digesting or is it breaking? Those are different. Digesting looks like price holding higher levels, volatility cooling off, dips getting bought faster than before, and panic selling failing to drive a sustained collapse. Breaking looks like failed bounces, volume spikes on down moves, and the market struggling to reclaim key levels that used to act like support. Right now, what we've seen is more consistent with digestion than with a clean break. That does not mean you can't get brutal pullbacks. It means the structure is not automatically shattered just because the chart stopped going vertical. And that leads to the next layer. People love comparing today to 1980 or 2011 like history is a photocopier. But the market doesn't owe you repetition. It rhymes, sure, but the instruments change, the players change, and the plumbing changes. In 1980, you had concentrated speculative forces trying to dominate a market that still had different inventory dynamics. In 2011, you had a global risk on risk-off machine dominated by central bank policy, ETF flows, and an economy that wasn't as dependent on silver-heavy tech as the world is now. Today's world is different in three huge ways. First, silver is embedded in modern infrastructure. It's in electronics, power grids, medical applications, chemical processes, and especially the clean energy build-out. Solar photovoltaics in particular are silver-hungry, and even small per-unit usage adds up when you scale production into the hundreds of millions of panels. That doesn't mean demand is infinite. It means there is a baseline of industrial pull that didn't exist at the same scale in earlier cycles. Second, the financial system is more leveraged and more fragile. That matters because when leverage unwinds, everything gets sold, including precious metals, regardless of fundamentals. So you can see drops that look illogical if you're only watching supply and demand. Third, trust is lower. People are more aware of currency dilution, debt expansion, and the policy toolbox being used over and over. That awareness changes behavior. It doesn't make people smarter. It makes them more reactive. And reactive crowds create volatility. Now, here's a cliffhanger you need to sit with. The most dangerous moment in a silver bull market is when gold quietly starts outperforming again for a short stretch. Why? Because that's when the crowd gets confused. They think silver lost its magic. They start switching assets. They start second-guessing. And that's often when the market sets the stage for the next silver burst because it resets positioning and calms the dopamine. So let's talk about the gold-silver ratio in plain language. The ratio is not a magic number. It's not a prophecy. It's a thermometer that tells you which metal is leading the dance. When the ratio falls, silver is winning. When the ratio rises, gold is winning. In major precious metal bull markets, the ratio tends to fall over time because silver usually runs harder later in the cycle. But that doesn't mean it falls smoothly. It drops, then pops, then drops again. And those pops, those little gold rebounds, can be opportunities if you know what you're looking at. Here's what I'm watching. After a big ratio drop, you often get a pause where the ratio chops sideways. During that pause, gold can look stronger because silver cools off more aggressively. That pause is not the end of the story. It's a reset. Now I'm going to challenge a popular idea you'll hear floating around. Any dip in the ratio is guaranteed to keep going. No. Ratios can stabilize for longer than people expect. They can even reverse for a while if the market enters a stress period. If stocks crack or credit spreads blow out, gold can temporarily regain leadership because it's viewed as the more conservative refuge. So if you're building a real portfolio, not a fantasy portfolio, you respect that possibility. You don't marry a single outcome. And that brings us to the big round numbers everyone is obsessed with. When gold approaches a headline milestone and silver approaches a headline milestone, the media machine wakes up. You get dramatic predictions. You get doom stories. You get it's over stories. You get to the moon stories. And none of that is for your benefit. It's content. Round numbers create drama. Drama creates clicks. Clicks create ad revenue. But round numbers also create real market behavior because humans anchor on them. You get profit taking, you get stop clusters, you get option strikes loaded with open interest, and you get the kind of price action that looks irrational until you remember that markets are just crowds with money. So yes, it would not surprise me at all to see extra turbulence as silver wrestles with the big psychological ceilings, and as gold keeps flirting with its own milestone zones. There may be a fake out, there may be a flush, there may be a sudden spike that convinces both bulls and bears that they were right before the market flips again. Now let's zoom out because this is where people miss the forest for the candles. If you adjust past prices for changes in purchasing power, a lot of new highs look less extreme. That doesn't mean inflation measures are perfect. They're not. Different households experience different inflation, and official numbers don't always capture what people actually feel in daily life. But adjusted charts are still useful because they stop you from treating a nominal price like it's the whole truth. When you look at silver through that lens, you can make a case that the market is not as overheated as it seems. You can also make a case that a true blow-off phase, if it comes, could be far more dramatic than what we've already seen. But again, don't let that turn into daydreaming. A blow-off phase is not a guarantee, it's a possibility. What is more grounded is this: silver is historically volatile, and it tends to punish people who chase late, overlever, and panic sell the first hard pullback. So if you're going to be involved in this market at all, your strategy has to be built for volatility, not against it. Now let me pivot to something most people are not talking about enough. There's a metal that has spent a long time looking sleepy while gold and silver did the spotlight dance. It's not new, it's not trendy, and because it's not trending, people ignore it. That's exactly why it matters. I'm talking about platinum. Platinum is weird because it sits at the intersection of industrial utility and store of value psychology, but it doesn't have the same cultural mythology that gold has. It also doesn't have the same small investors can hoard it easily narrative that silver has. So, it gets left out of the conversation. And yet, platinum is scarce, concentrated in a few regions of the world, and essential in a number of industrial applications. When it wakes up, it can move in a way that shocks people who assumed it was dead. Here's the key observation. There have been periods in history where platinum traded at a premium to gold. Not always, but often enough that a long stretch of platinum trading far below gold is not normal in the historical sense. It's an anomaly. Now, does that anomaly guarantee a snapback? No. But it tells you there's potential energy stored in the spread. And if you're someone who struggles with the physical bulk of silver storage, weight, transport, platinum can be a way to concentrate value into a smaller footprint. It's not better, it's different. It has its own risks, but it deserves attention. Now, I can already hear the pushback. Platinum isn't a traditional money metal. Fine, that's the argument. And it's partly true in the ancient history sense. But markets don't only price tradition, they price scarcity, utility, and demand. In a world where governments are running deficits like it's a sport, where debt rolls over into more debt, and where purchasing power keeps getting shaved, people look for anchors. Gold has been the anchor for centuries. Silver has been the hybrid anchor, money plus industry. Platinum, in my view, is the latecomer that gets re-rated when the crowd realizes it's been staring at the same three assets while ignoring a fourth that can play. Now let's come back to silver because this is the part that decides whether you make money or you donate money. People are worried about a crash because they remember the past spikes. The fear is understandable, but the reasoning behind it must crash like last time is lazy. So here's a more nuanced view. Yes, silver can crash. It can drop fast enough to make you question your sanity. But the question is, what kind of crash and from what kind of cause? If the move is driven primarily by speculative leverage, then margin hikes and liquidations can trigger a chain reaction. That's the classic pattern. Price rises, leverage piles in, exchanges raise margin, weak hands get forced out, price dumps, and the whole thing looks like a trap. If the move is driven by physical tightness and industrial pull, then paper leverage still matters. But it doesn't fully control the end game, because real buyers don't disappear just because a chart gets ugly. Manufacturers can't tell their production lines, "Sorry, the candlestick scared me." They need supply. Now, I'm going to push back on a claim that often gets repeated. Margin hikes automatically help the silver price because they scare off speculators. That's not always true. Margin hikes can reduce the froth, sure, but they can also reduce liquidity and amplify swings. They can force both longs and shorts to adjust, and they can make hedging more expensive for producers and commercial participants. So, the effect is not one-directional. It depends on who is most exposed and who is forced to move first. Here's what I think is more reliable. The longer a market stays in deficit, real deficit, not social media deficit, the more pressure builds for price to ration demand or incentivize supply. But supply doesn't turn on instantly. New mines take years. Permitting takes years. Capital takes years. And a large chunk of silver production comes as a byproduct of other mining operations. That means you can't just decide to produce more silver the way you can decide to produce more of a primary commodity. It rides on the back of other economics. So when demand is firm and supply is sticky, you get a setup where price becomes the adjustment mechanism. And price adjustment is rarely gentle. Now, while we're talking about demand, let me add fresh context you won't hear enough in the shouty videos. Silver demand is not just people buying coins. That's visible and it matters for sentiment, but industrial demand is the backbone. Electronics and electrification trends matter, solar matters, data centers matter, medical usage matters. And as economies modernize, even at slow speeds, silver doesn't get replaced easily in many applications because of its conductivity and performance traits. Yes, there are substitution efforts. Companies always try to reduce expensive inputs, but substitution is not instant, and it often comes with performance trade-offs. So the transition period can be long, and that's exactly the kind of timeline that produces persistent market tension. Now let's tie this back to the gold-silver ratio again, because this is where the next cliffhanger lives. If the ratio has been falling and then stalls, you might be tempted to think silver is done. But what if the stall is actually the setup for the next phase? What if the stall is the market letting gold catch its breath, pulling in a different class of buyer, and then handing the baton back to silver later at a higher base? That's the scenario that keeps catching people off guard. And it's why I keep saying, don't confuse a pause with a collapse. Now, somewhere in the middle of all this, let me do a quick creative detour. If you want to learn silver,